Welcome to a video that I like to call the deep dive video, and I need to explain this a little bit. Every week, I do a number of videos. I do a video each day, I do a weekly video, I do an intermarket analysis video. After I get done with all of those videos, I look back through all of the charts and I pick out those that I really didn't talk about in any of the videos, and I put them together into this video. And the reason why I call it a deep dive video is we have to look more under the surface at some of these charts to see if they're telling us anything, because sometimes we can still get some clues about what's happening. Now, I used to say this is my final video of the week, but now I've started to do another video after this called the What to Watch. And that is typically prepared about once a week, but it's also on an as needed basis, where if this deep dive video looks at the things that I really didn't talk about, the What to Watch video, I pull out of all the different videos and I say, yeah, this is what I'm really watching here. So I have been covering this information in other videos, but I'm just singling out the things that are most important that I'm observing right now, putting them in that video, which is a little bit shorter, and some of you may find some value in that. So far, with the few that I posted, the response has been pretty positive. But this video is being prepared for Monday, February 26th. The first thing that we look at is the VIX. The VIX measures fear in the S&P 500. There's another different index that we look at called the Vixen, which that's based on the NASDAQ 100. This is based on the S&P 500 and the options that trade in the S&P 500. Well, when they first designed this, it was meant to go on a static scale, 12 to the downside. That's when we get very low readings here, and 20 to the upside. But as with most things in life, this doesn't stick into those nice little ranges. There are periods of time, especially when the market's under a lot of pressure, when we go well up into another range. And so what I did is I put this fix on this chart, but then I make it invisible. On top of that, I put a 50-period exponential moving average. That's the blue line that you see here. And there are times when we get well above 20 and go into a higher range. Then when the market settles down and starts to go up, we typically go into a lower range. Then we ran into some problems after the COVID plunge and 2022. So we were in a higher range then. Now, if you look way over on the right-hand side, it looks like we're establishing a new lower range as the market has been more positive since October of 2022. Now, that could change at any time. We just want to keep an eye on this. This is just for information. We don't use this to make decisions. This is just to go, okay, the VIX is typically in a lower range right now. So to see lower ratings in the VIX, or rankings or numbers in the VIX, is not necessarily a strange thing. Another thing is to look at how fast is the VIX moving. And to measure the movement, I use an RSI based on 9 periods. Now, the VIX goes opposite the stocks. The stocks are going up, the VIX goes down. When stocks are going down, the VIX goes up. Well, we had a little bit of trouble recently where we did get an extreme reading with the RSI. But since that time, we've come down and the VIX has really settled down, so I haven't been showing this chart. Then we look at the MOVE index, which attempts to measure the volatility of bonds. We also look at the VIX, which measures the volatility of stocks. And the MOVE index is kind of new. It's only been around a couple of years. So doing a lot of historical testing with this is pretty much impossible. So I've been kind of testing this in real time to see what use this can give us. What I've done down below, the green line is the spread between the two, where I take the VIX and I subtract the MOVE index, and that gives us this green line. The red line is the S&P. What I find myself following the most is the correlation on the bottom. When this goes up, that means that the two indexes are moving in the same direction at the same time, whether up or down. And right now, they do have a pretty strong correlated relationship. Then we look at a ratio between the VIX and the MOVE index. This measures it a little bit different way, where mainly I follow the red moving average. When this is going down, that typically is positive for stocks. That means the VIX is underperforming the MOVE index, so the VIX is going down. When this starts to go back up like it did at the beginning of 2024, as we've been under some pressure, this is starting to go back up. And even though we're setting all-time highs in the S&P and the NASDAQ 100 and the Dow, they're still showing an increase of volatility when compared to bonds. Then we look at a fear gauge, and this has actually been declining. As the market's been going up, this is really more of what we're seeing when we look at this compared to the VIX. The VIX has been going down, and this has been going down also. Now, there were some times when the VIX started to go back up, and it's actually getting into a little bit of a higher range, but this is still showing that fear is decreasing. This is another fear gauge. When this is going down overall, that means that there's less fear about the economy, and this is hitting new lows for right now. Then we look at a different ratio between risk on and risk off. And for a while, I was really using this in every daily video. When this is going up, that means folks are getting into the riskier stocks. When this is going down, that means the market's probably going down and folks are more defensive, and sometimes even switching over to a risk off type of an environment where they get out of stocks and possibly even get into bonds. Well, ever since the beginning of 2024, we've just been chopping around. We're setting all-time highs with the S&P, but this is actually just kind of chopping. Now, this could be a warning sign in and of itself because we're not seeing this really thrust up with the rest of the market. And so we want to keep an eye on this. But as far as giving us some kind of directional value, it really hasn't been doing that so far this year. Then just to keep an eye on where are we, the previous all-time high was set in early January 2022. We've now set a new all-time high with the S&P in last Friday's session, and we're up 5.61% from the previous all-time high. Then we look at the cumulative advanced decline line for the NYSE, and we're watching the S&P go up and make new all-time highs. Now, the NYSE, that's more of a broader measure. And so the fact that it's lagging behind, yeah, we can understand that, but it would be a lot more positive if this was breaking out above these previous highs as the S&P is breaking out. Now, we are getting a little confirmation when we look down below. This is a regular NYSE advanced decline line where it is breaking out, and that's more confirming what we're seeing. It would be even more positive if we saw all three of these charts confirming each other, and we have one odd chart out right now. And here's another measure of the NYSE advanced decline line, and it's looking good. It's positive. It's breaking out above these previous highs, but it hasn't broken above the all-time high yet. So that would be even better if, since the S&P is setting all-time highs, if this could go up and set another all-time high too, that would give us more confirmation that we're just not seeing yet. And I was really following this. This is the skew index, where the VIX measures at the money options. The skew index looks at out of the money options. And when we get up into this red area, that means the market is anticipating some kind of a big move. And we were up in this area. Then we came down and we were back up. Then we came down. Well, we finally dropped down out of this area. Now, if you notice here, we did tick back up in Friday's session. We could go back up into this red area, but for right now, we've dropped down below it. And we saw a big move to the upside. Now, a lot of the market was pretty much anticipating a move to the downside because we were seeing some weakness in some other charts. But this really shot down when NVIDIA came out with their earnings and everything just skyrocketed up, and this ended up coming down. Then stockcharts.com has a thing called technical alerts, and I do include the daily alerts in the daily videos. This is trying to show all the alerts for the week, and I'm not going to read through all of these, but we start at the bottom, and then the very last signal was triggered at the top where gold had a MACD bullish crossover. And when you see a lot of red, that's negative. When you see a lot of blue or green, that's positive. And on the down days, we saw red. And on the up days, we saw a lot of blue or green. And I say blue or green because some people tell me that this looks green and other people tell me that this looks like it's blue. Then what they also do at stockcharts.com is they take either stocks or indexes or pretty much anything, and you can have a technical score, 0 to 100. The higher the number, the better looking the score. Well, in what I do, everything is surrounded by the S&P 500, but I also look at other indexes at the same time. I look at the Dow, I look at the NASDAQ 100, I look at the mid caps and the small caps, in addition to the S&P 500. And then I go and I look at the current score, and it gives me what is doing the best and what is doing the worst. Coming in first place, which has been in first place for most of, well, the last year to year and a half, has been the QQQs, which is the NASDAQ 100. And it did pop up a little bit this week, and we're coming in with the highest score of 90.4. Whenever I'm looking to go long, whether it's a stock, which I don't really trade stocks, I trade everything based on the S&P, but I'm only going to look at something when I want it to go higher, if it's in the high 80s to low 90s. If it's below, I'm not a big buyer on weakness. I like to buy into strength and sell into weakness, but that's my philosophy, and you may not share that. But Coming in second place now is the S&P 500, which did show a little bit of an improvement this past week. It's coming in at 85.4. Now, the QQQs, which is the NASDAQ 100, those are tech companies, and a lot of those companies in that index are also in the S&P 500 index, but the S&P 500 it's actually 505 stocks last time I checked. It has a lot of value companies. It has companies that have been around a long time. So it's not as growth oriented as the NASDAQ 100. Now, when we're really screaming to the upside, that's why the NASDAQ 100 outperforms. When we're under a little bit more pressure, sometimes you'll see the S&P 500 hold up a little bit better than the NASDAQ 100. Then coming in third place is the Dow, and there's going to be a change in the Dow coming in Monday's session, February 26th. They're taking Walgreens out of the Dow, and they're going to put in Amazon. So that may behave a little bit differently. And this is decided by the editors of the Wall Street Journal. They sit around, they have some experts, and they try to make a representation of the U.S. economy. And they've decided Walgreens isn't really cutting it anymore. We better put Amazon in. It's more indicative of how the U.S. economy is going right now. But anyway, in third place is the Diamonds. That's the ETF for the Dow, coming in at 78.4. So these are the large cap indexes. Then coming in fourth place are the mid caps, and they were down just a little bit, but they're holding up fairly well for the time being, and they're coming in at 66.8. And then in last place is the IWM, which is the ETF for the Russell 2000 small caps, and it ticked back up in Friday's session, but it's really been a disappointment. We thought we were going to get the January effect, and it did happen in December, but the minute we hit 2024, it's like the small caps have just found out at best they go sideways, but they have been declining quite a bit, and their score is at 52.5. Then we have some short-term charts. And I'd like to explain this. I try to take in this whole chart from the left side to the right side all together to get a big picture look at a small or a shorter term moving average measurement here. This is a rainbow chart going from 10 periods up to 50 periods with simple moving averages. And just by looking at all of this, then I focus over here on the right, and we can see that all of the lines are going up. That suggests a short-term uptrend, and price is above all of the lines. So this just tells us that the uptrend is in solid condition for right now. We look at the Stochk RSI, which is usually on one of our lists, whether we're going up or down. It's a pretty touchy indicator. This tries to take stochastics and the RSI and put them together. And it's typically giving us either an extreme positive or negative reading. Well, with the market chopping around over the last week or so, it doesn't really know what to do. So I haven't been including this in the chart, but we get a serious move up or down, and this is going to be back in the daily videos pretty quick. Then we look at a double and triple exponential moving average study based on 20 periods. That produces a green line and a blue line. The blue line moves faster, and we're above the blue line, and we're above both lines here. So this is also suggesting that the short-term trend is positive. Then we have a more standard use of a moving average, using a simple moving average and an exponential moving average. And the simple moving average treats all 20 periods the same, where an exponential moving average weights things more towards current price. So when we're really moving up, the blue line is going to be above the red line. And we're kind of seeing the red line coming back. As we saw a little bit of weakness earlier in the week, we came down and actually tested this 20-period moving average. I was showing this earlier in the week, and this is, if we fall below a trend line that we've been watching in the daily videos, this is the next line of support. But right now, we're kind of far away from it, so I haven't been showing that. But believe me, if we start to see some weakness coming down here, this chart is going to be back in the videos, and we're going to be watching this as potential support. Then intermediate term, we have another rainbow to look at, going from 50 periods to 100 periods. All of the lines are going up and price is above all of the lines. So the intermediate term trend is strongly positive. Here's another double and triple exponential moving average study based on 50 periods. This produces more of a channel, and we're above the triple exponential moving average. That means that we're seeing a pretty solid intermediate term uptrend, and price is above both of the lines. So this, for right now anyway, shows that the uptrend is solid. Then we have a thing called an anchored moving average. And the reason this is different is most moving averages go from the current price and then measure backwards. Those are traditional moving averages. This, an anchored moving average, you can go to a certain high or a low, and then have it extend forward up to the current time. So instead of going back, you're actually going forward with this. And this can be helpful when we're hitting tops or bottoms based on the moving average. We came down and actually went a little bit below this last October. This was looking pretty scary right here. We were losing pretty solid support, but then the market was able to recapture that and has been going back up. And since we're far away from this line, I haven't been showing it. There's a couple of other anchored moving averages on here going back to COVID lows that were set. Then we have a Connors RSI, which is an oscillator. And this gyrates a lot day in and day out. What we're looking for are extreme positive or negative readings, and we don't get those very often. We're not getting one now, so I haven't been showing this. Then here's a 50-period moving average study where we're showing the red line and the blue line here, and price is well above. And this is also suggesting the intermediate term trend is positive. Then we jump out to 100 periods, and price is well above both of those moving averages. So in the longer intermediate term, we're also looking positive. And this is how far away are we from the 200 period simple moving average. When we're green and going up, that means that we're above that moving average. So the long-term trend is also positive. Then we look at standard deviation, which does not measure direction. It measures speed. When this really spikes up, that means that it's moving either up or down really quickly. Well, we are seeing a little bit of a pickup. We've come back up to the moving average here. We had a really huge gap higher after NVIDIA reported their earnings. And there's a huge gap right now in the S&P, and that really shot the standard deviation measure back up. But we're still below this moving average. The mass index is not generating a signal right now. We pay attention to this when we get close to the red dashed line and the blue line. We're far away, so there's no need to show this one. We want to keep an eye on the S&P 100, which is on the bottom, and then compare it with the S&P 500, which is on the top. We're looking for any kind of divergences here. For the most part, they're converging with each other, not showing anything that's too far out of line. And these are just some measurements that I've done, and I did these myself, so they may not be exact. This is going from major tops to major bottoms here. We did hit a bottom. Well, we hit a top in July of 2023. Then we hit a bottom in October 2023. And since that time, we've been bouncing up and setting new all-time highs. And based on Friday's close, we're up 19.35% from that October low. Then Bollinger Bands. We did show this a little bit earlier in the week. And you can use Bollinger Bands for a lot of different reasons. Where we're at within the Bollinger Band itself, whether we're above or below the midpoint, whether the lines are going up or down. You can also look for negative divergences in here. I know John Bollinger loves to pick this out. When we set a low and then come back, let's see, where's a good one? This one, where we set a low, and then we set a lower low based on price, but a higher low based on the Bollinger Bands. Oh, that's just like, that's Christmas, Thanksgiving, and his birthday all rolled into one. He just loves to point that out. But there's other ways you can use this too. When we really shoot to the upside and we get outside of the upper Bollinger Band, that's what the percent B indicator looks at. And we were up above that upper band after Thursday's close because of the upward move that we saw. Then in Friday's session, we've come back down. The CMB Composite Index, this is meant to be a standalone trading system. I don't use it like that. I use this like an oscillator, looking for extreme positive or negative readings. The Pring Bottom Fisher is supposed to help us when we're going down and then looking to bottom out and start to go back up. It's actually giving us a signal now as the market's been going up. So try to figure that one out. Long term, we have another rainbow going from 50 periods up to 250 periods. The lines are going up, prices above all of the lines, and prices going up as well. The long-term trend is up. Then this is a daily special K chart. This is a very long-term oscillator. We crossed back in November, and we haven't crossed since then. We don't see a lot of crosses with this. So I mention this in each daily video, but I only show the chart in this video. Now, if we start to get to the point where we're going to see some kind of a cross here, then I'll start to show this chart. And then we look at a weekly chart of the S&P on top, the weekly chart of the DAX, which is the German index, and we're seeing that the two are fairly strongly correlated with each other. So, and that can be either up or down. So if Europe's having a really good day, that might feed into the US market, at least possibly having a good day. Now, don't use this as any kind of a strict rule, because there's been so many times when Europe will have a solid day and it looks like we're having a good open in the US the US market likes to think for itself, and the rest of the world tends to follow what happens in the US market. So just because things are going good in Europe doesn't necessarily mean it's going to bleed over. It might help with the open, but ultimately the close is going to be dictated by folks in the US. Where the Asian markets, they tend to follow what has happened in the US. Just something that I've observed over the years. Then we have the 10-year yield on top, and we subtract the German 10-year yield. Since US rates are higher, that gives us a positive answer. And sometimes we can compare that to the US dollar index. It's not really helping us right now. When we get up into this blue area, that means that there's a strong correlation between the top chart and the middle chart, and that's not happening right now. And some different areas of support and resistance. I was showing this earlier in the week. This is a 20-period simple moving average of the open, high, low, and close. This is a simple indicator I developed decades ago for a trading system. I stopped using the trading system, but I kept the indicator. And this is producing a little mini rainbow here. I changed the colors to kind of try to make it look cool. And a lot of times when we're going up and then we fall back, one of these lines in this rainbow may act as support. And you can see that that tends to happen. We actually went into the rainbow earlier in the week this week, but then shot up above that. We can also look at the direction of the rainbow. It's going up and price is above the rainbow, so that is showing that things are positive. And then we're kind of getting close to another end of a 50-day cycle. The last cycle was on January 2nd. It looked like it was going to be to the downside, but try to tell it to that now. I don't know if this is all that helpful or not. I don't use this to make decisions. I know there are people that the sun rises and sets on cycles that they use. Okay, fine. I use them more as guidelines. I like to use confirmation in other ways because sometimes, yeah, this marks a bottom. Sometimes it marks a top, but a lot of times it's like, 50 days. We don't care. We're just going to keep doing what we were doing before. Ichimoku cloud. Some people really rely heavily on this. I use it in a pretty simple way. Really, all this is a set of moving averages that are shifted forward. When the moving averages are positive, the shifted forward cloud is green. When the moving averages are going down, the shifted forward cloud is red. And sometimes when we get above the cloud and then fall back, the cloud may act as support. Sometimes when we're below the cloud and we start to bounce, the overhead cloud may act as resistance. We're far away from the cloud right now, so I haven't been showing this chart. And some broad market measures. I talked about this earlier. This is the Vixen, which measures the volatility of the NASDAQ 100. And then we look at a ratio between the QQQs and the diamonds, and they're not really strongly correlated right now. They're almost in neutral territory. Just because the Qs are going up doesn't necessarily mean the Dow is going up and vice versa. And then we're keeping an eye on the banks. So far, it's been just the New York Community Bank that's come out saying, we got some problems here. Well, we're waiting to see if other banks are going to start to have some problems too. And in the meantime, we see the bank ETF going sideways. We also keep an eye on the regional banking ETF because the New York Community Bank is a regional bank. And it was looking a lot better. And then that news came out and boom, it just shot down. And we do a ratio between the regional banking ETF and the financial sector, and it's really underperforming right now. Folks are really concerned about the regional banks, and they most likely should be. And some rate of change charts. These are just for information. This goes back 250 periods, and we are going up with this chart. We're also going up with this other chart. Now, if we get up to this green, blue line here, yes, I do know my colors. This is sometimes where we get to an extreme reading, but we could still go above that. But this is just showing that the longer-term trend, very long-term, is positive. And looking at bonds, where we look at 1 to 3 year bonds and compare them with 3 to 7 year bonds, when this is going back up, that means that the market is anticipating a rise in interest rates. When this is going down, that means they think that interest rates are going to start coming down. But you notice right here, since the beginning of 2024, we've been going back up. The economic reports have been stronger than expected. Inflation has come in with CPI and PPI stronger than expected. We're going to get another inflation reading in the upcoming week. And this is causing some concern to the market. This is where we bottomed back in October. And as this was coming down, that was giving a lot of support to stocks. Even though this has been going up, we're still seeing stocks going up anyway, which is another warning sign. Because in this kind of an environment, usually when interest rates go up, that puts pressure on stocks. But we're really not seeing that all that much right now. Here's an inverse of that same chart. We look at the 7 to 10 year bond and compare it with the 3 to 7 year bond. When this is going up, that means that the 7 to 10 years outperforming the shorter term bond. Now it's starting to go back down as the shorter term interest rates have been actually going up faster than the longer interest rates. And then we look at the TLT, which is the long-term bond ETF. That is the blue line here, where it's been going up. And then we compare that with the S&P 500, which is the red line. And their longer-term relationship is really dropping off here. It's like they're legally separated or something, where for a lot of the end of 2023, their relationship was really strong. Well, now they're kind of going their separate ways. We are seeing some improvement here with the shorter term 10 period correlation. So that is showing a little bit of an improvement. And then on the bottom, these are just different ways to measure between the spread. I don't pay as much of attention to this. It's mainly the long-term relationship and then the short-term relationship. And then we look at another correlation between the QQQs and the TLT. They're actually having a tendency to go in opposite directions. We're keeping an eye on the yield curves, but we've been watching them for over 2 years now with the 10 to the 2 and the 10 to the 3 month. These are the most important ones that the market pays attention to, and they remain inverted now for quite a while. What we're waiting to see is, are they going to go back to being normal? And then quite often that starts the countdown to see, are we in fact going to go into a recession? And then we look at TIPS, which are Treasury inflation protected securities. These are shorter term and they can adjust for inflation. So when interest rates are going up, people want to get into those. And that's when we see them outperforming. When people think, okay, interest rates have topped out and they're going to start coming down, that's when we see this ratio start to come down. Then we can compare this to further out bonds. It's a little more prevalent here. The TIPS were outperforming as interest rates are going up. Then over the summer, as stocks were under pressure, we saw this going up again. We finally hit a top and this was going down. That's as stocks were going up. But now you can see we're starting to go back up again over here in 2024 as the market isn't as confident about what's going to happen with interest rates as they were just a couple of months ago. And then we look at 1 to 3 month T-bill, which you could call cash. We compare that with 3 to 7 year bonds. When this is going up, that just means the cash is outperforming. When this is going down, that means bonds are outperforming. Well, now we're starting to go back up as interest rates have been going up because there's some more uncertainty about interest rates right now. Then we compare the S&P with the 3 to 7 year bond. When we're going up and outperforming like we are and have been for quite a while, the market is anticipating a soft landing, meaning that, okay, we've seen some economic slowdown. We've been in a rising interest rate environment, but we're not going to go into a recession. That's the definition of a soft landing. And that's what the market is anticipating and has been anticipating for quite some time. And then I have a thing called possible positive scenarios. These are designed for when we're really going down. I use them heavily in 2022, but there's still some uses that we can use every day. Some of these I show in every daily video. Others I just show from time to time as they're actually telling us something. The first one here is the percent of S&P 500 stocks that are above their 200-day simple moving average. I have a different study that shows this same thing, but I look at it in a different way. And we can use this like an oscillator when we get extreme positive or negative. Also, when we're above 50, the midpoint, that's also more positive. We're not getting any kind of an extreme reading right now, but we are still positive, even though we're seeing a bit of a negative divergence here. As the S&P has been going up, this has actually been going down, but this is a longer term chart, so it may not be as obvious to see here. Then we look at the stocks above their 50-day moving average. This did hit a real extreme reading at the end of 2023, and we've been coming down. We've been showing some improvement here, but we're also seeing a bit of a negative divergence. The S&P is hitting all-time highs, and this is not coming back and hitting highs. That's a little bit of a concern. We also want to compare this to the small caps. Also had an extreme reading at the end of 2023, showing a little bit of an improvement here. And we also keep an eye on the small caps where they've been weaker now. They also went extreme at the end of 2023, but they're pulling back and they're actually getting close to dropping below the midpoint. And then this is a 19-day exponential moving average study of the advanced decline ratio. We have one area based on price, another area based on volume. When we're positive with both, that means that we're looking good. So we're positive based on price and volume. Sometimes we get extreme readings with this indicator. We're not getting one now, which is why I haven't been showing this. Thank you. I really hope you found this helpful. This is not meant to be a standalone video. It will do you more benefit if you do go in and look at the daily videos. especially those. If you want to, you can check out the weekly video and the intermarket analysis video. I will be preparing a what to watch video that just gives the high level view of things that I'm really watching, at least for right now. And that will be updated on an as needed basis. So I hope you have a really great weekend, and I will talk to you in the next video.